Okay, I would like to talk a little bit about some of the other fine print and risks associated with these Delaware Statutory Trusts, at least this particular Delaware Statutory Trust. So let's see. It says, all potential investors must read the PPM, that's the Private Placement Memorandum, remember this one? And no person may invest without acknowledging receipt and complete review of the PPM. So they're saying you have to acknowledge that you read it, but they're hoping you didn't read it. They're expecting you not to read it. Let's continue. Investments are suitable for accredited investors only. Accredited investor is either, number one, an individual net worth or joint net worth with his or her spouse of more than $1 million, excluding primary residence, or, number two, individual income in excess of $200,000 or joint income with his or her spouse in excess of $300,000 in each of the 2 most recent years, and has a reasonable expectation of reaching the same income level in the current year. The legal assumption of this is that such individuals have the resources and the sophistication to do their own due diligence. Again, we talked about that. Hiring accountants, hiring lawyers, somebody to go through all this information. And this is also, and we'll talk about this in a minute, what makes it so that these trusts are exempt from certain SEC regulations. Let's continue. In certain limited situations in which the subject properties were in foreclosure, this company has allowed investors to exchange their interests for a new program. So I guess they let people kind of roll into a different program. I think this probably because it would have made them look really, really bad if they didn't. Because such exchanges result in an investment continuation, the original programs are not considered full cycle programs for these purposes. So these programs that maybe something went wrong, really wrong, they let people roll into another Delaware Statutory Trusts under the same company, which is nice. It may mitigate some of the risk of default. But the problem is that when they're giving you the returns, they're giving you all the data on the returns for the internal rate of return and the total return, which we'll talk about in another video. That one, they specify that it's for completed programs. So they could be eliminating some of the real dogs from their statistics, is what we call survivor bias, when some kind of fund or in this case these trusts actually go out of business, and so they don't count them. So how many uncompleted programs were there? I don't know. And also consider this, that these are, like I said, these trusts, a lot of times they're being pitched to people that own property, that want to get out of that and look for a passive investment. So if you're 70 years old or older and you get a total dog of a program that lasts 3 to 10 years, that could be a problem, because you have to think about your time horizon. How long can you afford to have this money tied up for? The purchase of interests in any of this company's sponsored program is speculative and is suitable only for persons who have no need for liquidity in their investment and who can afford to lose their entire investment. Did you read all that? You had to sign that you read all that, right? It is risky. Let's continue. Oh, this is good here. Programs offer and sell interests pursuant to exemptions from the registration provisions of federal and state law, and accordingly, those interests are subject to restrictions on transfer, meaning it's hard. They're not liquid. They're not sold on an open market, so you can't get rid of them very easily. DST interests may be offered and sold in private placement offerings pursuant to an exemption from the registration requirements of the Securities Act of 1933, as amended in accordance with Regulation D. This contributes to the lack of liquidity, but it also makes them exempt from certain SEC regulations, and it says very clearly in there there will be no audited financial statements. So you're taking their word for it. Nobody's auditing it. We'll talk about this. We've talked about it before. We'll talk about it more later. Is that all these entities that are taking care of things, are the ones that are selling you the program, the ones that are managing the properties, everything, the ones that will be selling the properties, they're all under one parent company. They're all related parties, and they're offering you. They have no independent auditor that's auditing these financial statements. Each investor must represent in writing that, number one, he has consulted with his, her, or its tax advisor, and I thought this one was also interesting, is not relying on any of the statements made in this memorandum regarding the qualification of purchase of interests under Section 1031. So you're signing off that you got your own people, your own CPA, your own attorney to look over all this stuff so that they're covered if you come back later and say, oh, I didn't know about this. So, and remember, the costs of due diligence are all up front. So how much cash do you have to put out of pocket before your payout comes in, 6 years? Assuming the property values actually go up? Let's take a look at some other risks. Oh, I like this one, because this was on their own brochure. And it said, institutional investors such as pension funds and endowments regularly allocate 10 to 12% of their investment portfolio in real estate. 10 to 12%, okay. If you would like to invest 10 to 12% in the real estate market, that's okay. That's not totally unreasonable, but it's also not essential. A broad market index fund will likely include real estate investment trusts that are traded on an exchange, and non-exchange traded real estate investment trusts, like the Delaware Statutory Trusts, are basically buyer beware products. And the SEC website actually has a warning about non-traded REITs. If you would like to invest in real estate, well, I can tell you that since 2001, Vanguard's REIT index fund has returned about 11.5% per year. So when we talk about returns in another video, then we'll come back to that again too. Let's see. Just a warning about risks inherent with real estate investments. There are risks inherent with any investment, and then when you put it into one particular market segment, and if you are putting a huge amount of your portfolio into one particular market segment, then you're going to increase volatility, where you may not get necessarily get an expected return return premium to compensate for that volatility. Let's see. If an operating trust is unable to sell or otherwise dispose of its property before the maturity date of the respective loan, it may be unable to repay the loan and may have to cause a transfer distribution. Okay, so there could be some problems if they can't sell the property, because maybe property values are going down and they would rather hold it for a while, but then their loan is coming due. And I was taking a look at some of the loans, and they seem to be using loans with balloon payments because they're counting on selling the payments before the balloon payment comes due. But things happen, right? Property values might fluctuate, and in a way that they feel like it's not a good time to sell. Also, financing terms on this particular Private Placement Memorandum, there were four separate properties. Three of those four properties had variable rate loans on them. And right now, because interest rates have been so low, and right now they have nowhere to go but up. So looking into the future, you can think that increased interest rates on the loans that they're taking out are also going to eat into your returns. Okay, so even taking into consideration what their returns, which are not terribly impressive, have been over the last, say, 10 years or so, that those were taking loans when the federal funds rate was basically zero. Okay, so I think that's about where we will leave it for now, and we'll talk about some other issues pretty soon in a future video. Okay?